All right, so let's continue our discussion about liabilities. To this point, we've been talking about liabilities that we know to an absolute certainty as business management or as accountant for a business, that these liabilities are going to exist, and we also know to a certainty how much that liability is going to be for. So just a quick recap. And an example. We could talk about wages or salaries payable, and two things. Number one, we know when we hire employees that we're going to have a liability to pay those employees. And we also know how much they make, so we can determine how much that liability is going to be for. We can also figure out what our liabilities are for payroll taxes and all those other types of things that go along with payroll. Let's say if we borrow money, whether it's a short-term loan or more of a long-term loan, well, we know that we've done it, so we know that the liability exists, and we also know how much we owe. But I would also say that sometimes in business we have some other liabilities that are a little more difficult to estimate. We talked about vacation pay. We talked about pension plans, and then, depending on what, usually we have pretty easy to estimate. If we have one of the old school pensions, those can be troublesome because people, they're based on a complex formula. We have another video on warranties. We know that merchandise is going to be returned, but we never know exactly how much. But we also have legal liabilities that crop up, potential liabilities, and we call these are part of what we call contingent liabilities. And we've got an example here based upon some lawsuits that a company is experiencing. Jones Company, it says several months ago, Jones Company experienced a spill of hazardous materials into the White River from one of its plants. Well, that's not good. As a result, the Environmental Protection Agency fined the company $405,000. The company contested the fine. That means that they're going to court and they are going to attempt to have this fine set aside in a court of law. In addition, an employee is seeking $180,000 damages related to the bill. Finally, a homeowner has sued the company for $260,000. Although the homeowner lives 30 miles downstream from the plant, he believes that the spill has reduced his home's resale value by $260,000. Okay, so I took a moment to I list 4 things here, and these are some criteria that we're going to use when we go about deciding how to handle contingent liabilities. There are essentially 3 things that we might have to do. The first thing that we need to do potentially is record the liability and also disclose the liability in the notes to the financial statement. So record liability and disclose liability in financial statements. Abbreviate a little bit here. These are actions that we can take. Two is disclose notes to the financial statements only. And 3 is do nothing. So up here I've got probable and estimable, probable and not estimable, reasonably possible, and remote. So these items up here deal with likelihood. Likelihood of what? Likelihood that we're going to have a liability. So let me just run through some of these rules and you'll see how they match up. If we have a contingent liability that is probable, in other words, we've been sued and we're probably going to lose. Okay? So we have probable, and let's also say that we've been sued for $1 million and we think that we're going to, we're going to lose $1 million. We're going to lose all the way. In this case, the action that we would take correspond, number one, we would record the liability for $1 million and we would disclose the liability in the financial statements. Second, let's go ahead and number these 2, 3, and 4. Let's see. Number 2, probable and not estimable means we don't know how much we're going to lose. We've been sued for $1 million and we're probably going to lose, but we don't really know. We have no idea. Let's just say that the nature of the lawsuit, we could actually end up losing more than $1 million. If a jury is involved, something like that, we might lose $100,000. We have no idea. Well, we can't exactly record a liability if we cannot estimate the amount of obligation. So what we would do here is we would disclose in the notes only. We can disclose that, we're probably going to lose this, but we don't have any way of estimating the amount of loss. But we still need to disclose that in the notes to the financial statements. 3, reasonably possible. Okay, so here we have a situation where maybe we have a 55% chance of winning, even a 65% chance of winning, maybe even a 75% chance of winning. But it is still reasonably possible that we could lose. Well, we don't have, the odds are not in our, so much against that we need to record a liability, but with both 2 and 3 related to likelihood, we need to disclose the notes to the financial statements only. And then finally, if the likelihood of incurring the liability is remote, we do nothing. Okay? With that said, let's look at this example here. We've read the first scenario, or we've read the scenario, and it says, Jones's legal counsel believes the following will happen in relation to these incidents. They say it is probable that the EPA fine will stand. In other words, they fined us for $405,000. That's probably what we're going to have to pay. B, an out-of-court settlement for $165,000 has recently been reached with the employee, with the final papers to be signed next week. Okay. Counsel believes that the homeowner's case, that's the one who lives 30 miles downstream, is weak and will be decided in favor of Jones Company. Finally, other litigation related to the spill is possible, but the damage amounts are uncertain. So what they want us to do is they say, based on this information, journalize the contingent liabilities associated with the spill. Use the account damage, awards, and fines to recognize the expense for the period. Okay, so if we're recognizing an expense with this account here, that looks to be our debit. Okay, so here's the story. It is, with regard to number 1, it is probable that the EPA fine will stand, and we know that we can estimate it because we have the amount right here. So we're going to have to not only disclose the notes to the financial statements, but we're going to have to record a liability for $405,000. Now, in the interest of saving some time, I'm only going to do this once. But we're going to make one journal entry. We have settled with an employee for $165,000. The papers are going to be signed next week, so that's very, very probable and completely estimable. Okay? So, we have a journal here, and we don't have a date. So let's just let's see here. What was the name of the account that they told us to use? Damage awards and fines. And we're going to go ahead and we're going to add the 405 and the 165. And that's going to be our debit. And we're going to have two credits. First, we're going to have one, and I'm just making this up, EPA fine payable. And that's going to be for the 405. And then we're also going to have this $165,000. And let's see here. So let's go employee settlement payable. The exact names of these are not exactly, that's not really important. But we have $570,000 in debits, and then we have $570,000 in credits. Okay? So that takes care of A, and that takes care of B. We don't have room on this piece of paper to actually write, prepare any disclosure note related to the spill, but we can still go over these and talk about what needs to happen. With C, it says, counsel believes that the homeowner's case is weak and will be decided in favor of Jones Company. So we have to determine what the likelihood is here. Well, it's not probable that we're going to lose. It is probably reasonably possible that we're going to lose. Homeowner's case is weak, but who knows what's going to happen with this jury. Even if we haven't, let's just say an 80% chance of winning this, a 20% chance of losing is still reasonably possible. So what we're going to do here for C is we're going to disclose only. So back to A, we're going to record a liability and disclose in the notes to the financial statements. With B, we're also going to record and disclose. C, disclose only. D, other litigation related to the spill is possible, but the damage amounts are uncertain. And probably we could also say that the likelihood is of whether we're going to win or not is uncertain because they haven't even happened yet. But in the interest of conservatism, we should probably disclose this. Actually, there's no probably to it. We should, and we'll have to. Okay? Let's see here. So, we had A, B, C, and D. We did not have anything that was remote, so there was nothing that we could just ignore. Okay? All right, I think that's a pretty good explanation for what I want you to understand about contingent liability, so let's leave it at that, and we're going to have a video over warranty liabilities after this.